Friends, welcome back to my YouTube channel. I am SP Singh, retired DGM Punjab National Bank, bank's executive trainer, a banking and financial consultant, and a motivational speaker. Today, I am going to talk to you on key policy rates. And we will start with what is repo rate. And here the key policy rate, I mean the rates mentioned in the monetary policy which is reviewed every 2 months by RBI, and the policy is administered and implemented by RBI. So we start with the first rate, which is very important, and the question is, what is repo rate? Now the answer to this question is the rate at which RBI lends to commercial banks. Now second question will arise, do RBI really lend to commercial banks? The answer is yes. You may have heard about Liquidity Adjustment Facility LAF, and all these rates are mentioned under that liquidity adjustment facility. Liquidity adjustment facility is a very critical, very important, very significant facility available to the commercial banks. In case of exigencies, in case of liquidity mismatch, their asset liabilities mismatch, when they face a problem of immediate liquidity, they approach RBI and borrow from RBI under this facility to adjust their liquidity for the time being. So the answer to the question, what is repo rate? The rate at which RBI lends to commercial banks, and at present it is 6.50%. Now the second aspect of this is that repo rate these days is a reference rate also. What do I mean by this? I mean by this that various lending rates, when decided by commercial banks, are now linked to repo rate, and in general they call it RLLR, repo rate linked lending rate. Earlier before repo rate came into being, the bank rate used to be the reference rate, but after the introduction of the repo rate in the banking industry, bank rate is no more a reference rate, only repo rate is the reference rate. So this rate is very important, and monetary policy is reviewed every 2 months. The rate, these policy rates may be reviewed and changed during that period of review. So we have to keep pace. We have to keep ourselves updated on these policy rates every time. So let us proceed. Second rate, what is reverse repo rate? Now reverse repo rate is the rate at which RBI borrows from commercial banks, or the rate at which commercial banks lend to RBI. Here also, I would like to tell you that, do RBI really borrow from commercial banks? These days, actually, every repo operation has got a fixed period, and that repo operation that repo transaction has to be reversed on a fixed date. Currently, and under normal circumstances, three types of repos are in operation. One is overnight repo transaction. Second is term repo. Term repos may be 7-day, 14-day and 28 days repos. During that COVID pandemic period, RBI introduced LTROs, long-term repo operations also. And they also introduced TLTROs, targeted long-term repo operations. But now the circumstances are normal. At present, these term repos, overnight repos, and after the expiry of the term transaction has to be reversed. So reverse repos are also there. This way, we can conclude that every repo transaction has to be reversed on its maturity. If the bank has borrowed for overnight, so next day, by the close of the business, the bank has to repay whatever he has borrowed. If it is a term repo, after the expiry of the term, the transaction has to be reversed. So the rate at which RBI borrows from commercial banks is known as reverse repo rate. And currently, RBI has also introduced another facility in which I will come a moment later. So when a repo transaction has taken place, it has to be reversed. And when the RBI is of the view that RBI has to suck out or absorb the liquidity from the economy, then they conduct reverse repo transactions, and under that they suck the funds. Under reverse repo, the commercial banks will transfer the funds to RBI, and RBI will provide them the securities. So liquidity in the economy will go down. That will depend upon repo transaction and reverse repo transaction. Both of them will depend upon the inflation prevalent at that moment. If the rate of inflation is high, RBI would like to reduce it. RBI would like to control it by conducting absorption of liquidity operations, means reverse repo operations. And if the liquidity in the system is less, RBI feels that liquidity must be infused into the system. Under those circumstances, RBI will lend to commercial banks through repo transactions. I hope I am very clear on this, and I proceed to another facility which has been introduced by RBI only last year. What is a standing deposit facility rate? And this facility, the standing deposit facility, in short we call it SDF. This facility has made reverse repo transactions redundant. Why? Because under this facility, the rate at which commercial banks can park their surplus funds with RBI without any collateral or a short tenor or for longer tenors also. So this is the facility which has replaced the reverse repo transactions. Only fixed overnight reverse repos are available at present. A standing deposit facility is also a very good facility, under which when the bankers have surplus funds, they can park these funds with RBI for shorter periods as well as for longer tenures. And the rate is also announced by RBI at the time of review of the policy, along with the repo rate always, and at present the SDF rate is 6.25%. Let us proceed further with another rate. What is bank rate? Now the bank rate as defined in the text and now not very relevant these days, the use of the bank rate is only one, in my opinion, and that is to impose penalties on the banks. And I will explain that, but let us first have a look at the rate at which RBI used to rediscount the bills of first class parties. And this is no longer a reference rate, which I have already explained to you. The rate at which RBI used to rediscount the bills of first class parties. So earlier, when the bank rate was a reference rate, a very important rate before the introduction of the repo rate, it was the rate at which RBI used to rediscount the bills of first class parties. And here first class parties means rather include the Reliance Industries, the Tatas, the companies of Birla Group, and all the blue chip companies used to be the first class parties. They used to discount their bills from the commercial banks, and in case of need of funds, commercial bank could approach RBI with those discounted bills for rediscounting facility, and RBI used to rediscount those bills of first class parties, and funds were made available to the commercial banks. So no longer it is a reference rate, but it is being used for imposing penalties. We may have heard about cash reserve ratio. We may have heard about statutory liquidity ratio, CRR and SLR. All the commercial banks, or scheduled commercial banks rather, have to maintain these two reserves as per RBI norms. But in case the commercial banks fail to maintain those reserves at that particular level which RBI has desired, RBI has announced that scheduled commercial banks have to maintain CRR at the rate of 4.5% at present and SLR at the rate of 18% at present. If you fail to maintain this level, RBI imposes penalties, and that penalties is for the first default 3% plus bank rate, or bank rate plus 3%. Second or subsequent defaults, bank rate plus 5%. In both the cases, CRR, SLR, in both the cases, it is bank rate plus 3% for the first default, bank rate plus 5% for second and subsequent defaults. So I hope all of you are now very clear about the bank rate. And another rate is marginal standing facility rate. So what is MSF rate? MSF is an additional borrowing window available to the banks under which they can borrow overnight up to 2% of their NDTL. This is individual banks NDTL, net demand and time liabilities. So let me explain that this window is additional borrowing window available to the commercial banks, but this borrowing is available at a higher rate and to a limit of 2% of their NDTL only. So this is a further facility, an additional facility. If the bank is under stress, they can borrow under repo as per the availability as per their percentage of limit, and in addition to that they can borrow under marginal standing facility also. So I hope these rates are the rates under monetary policy: the repo rate, reverse repo rate, the bank rate, marginal standing facility rate, and newly introduced standing deposit facility rate. and I hope you will be very clear in your minds now on these rates. So I would request you to please do like, share and subscribe to my YouTube channel. Like and share my videos. Subscribe to my YouTube channel. Also press the bell icon button so that you get my video notifications in time. And also I will wait for your beautiful and valuable comments on this video. Thank you. Thank you very much. I am signing off.